Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, November 9th, 2022, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we are going to take a look back at some of the trades that have not gone that well for me within 22. And we're going to try to do a little working session here in this episode. So could look a little bit or sound a little bit different than past episodes, but we'll see how that goes. Before we hop into that discussion, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, several of the other Blockhead traders. Love to hear what you're trading. Love to hear what you want to know about. You can also pick this up wherever you get your podcasts, and if you can't find it, let us know and we will get it there. Lastly, you can follow all of my trades, the good, the bad, and the ugly at thetagang.com/sprocket888. Well, let's hop to this week's content, Viper, and that is a reflection back that I've had over the recent history here. I don't know about you, but it seems we are in another market's going to zero, and what seems to have set it off this time is a crypto apocalypse liquidity thing, and it is just it's hammer. Crypto markets are just insanely just dive bombing right now. That's bleeding over into the equities world. It doesn't help with companies missing earnings, interest rates going up, inflation fears, CPI number coming out, and it is just kind of doom and gloom everywhere. And I heard a funny quote on the mainstream media when they were talking about, well, how do we know when we're going to bottom? And whoever the analyst was, I don't even remember who they had in there, but they said, well, you see, the problem is the retail traders are still about 67% engaged in the market, and we really need them to call it quits before we can fully bottom. And so I'm glad that I'm doing my part in keeping this thing going. And they cited a statistic. They said back in 2008 or 2009, the retail trader dropped down to about 39% participation. So I guess, I'm sorry guys, but we're part of the problem because we haven't quit yet.
That's a new one. I haven't heard that before.
Oh, it was great. I was like, are you serious? Oh man.
We're part of the problem. Well, I mean, if we're here, then why aren't you selling? Are we just exit liquidity? Like, I don't know.
I don't know. I'm like, why would I sell now? Anyway, before all of that kind of came up, I was really doing my own reflections back on some of the trades because, to be honest, I mean, you can look back in the episodes that came out in 22. There weren't really very many shiny things where I'm like, yeah, bang that one out for a great win. I've had a lot of losses here in 22, and that's in stark contrast to, you can go back to our episode where I did a year in review of 2021, and that was a great year for me. And I start to thinking, well, a lot of my mechanics were the same. What's different? I mean, yes, I experimented with new things this year, but what's really underlying there? And one of the things that I'm starting to consider, and we'll see if it kind of pans out, is maybe this theory of the rising tide raises all boats. And for the majority of 21, it was a bull market, up and up and up and up and up. So maybe it was just me throwing darts at a dartboard that the bullseye was oversized and you just naturally hit a bunch of things. And that got me thinking as to far as, because fundamentally, I still truly believe in elevated volatility and shorting volatility. But I am starting to question how indiscriminate you can really be with that. And so what I want to try to do in this episode is like a working session with you, Viper, to try to come to a little bit more, I'll call it mechanical trading, where I'm going to take in some signals from maybe price action, ranges, upper bound, lower bound levels, something like that, and more mechanically pair it to my what I consider a very mechanical option trading strategy to really augment it. And this episode, I can't tell you what it's going to sound like at the end because we're going to record a whole bunch of stuff, and then I'm going to kind of jump cut out different content so you guys don't get bored the whole time. And that's the approach I think we should take this time, Viper. We'll experiment with our artistic license.
Yeah. So, and the one thing I'd say about your reflection is obviously it's very important, and I think you're sort of on the right track in that there was an underlying theme there in what you said. We've obviously talked about on the show when people are buying and selling shares, just openly that it's easy when you're in a bull market, in a particular market, and you're just buying things and you wait a week and all of a sudden you can sell them. And we've kind of used that. We've used options as a way to be more mechanical, like you said. And that is true. Everything we've talked about, I certainly believe in the option strategy. But what I'm starting to feel like is along the same lines of what you were talking about, where there is a nuance to the option strategy because it's a more complex, complicated strategy, that there definitely is still room for it to be easily, I'm using the word easy very loosely, but easily beneficial when the market is going one direction. And I would say the reason for that is your volatility drops. You get these big volatility drops in an up only market. The probability is way in your favor that thing's going to keep going. And now, obviously, in a reversed market, a down only market, those volatility drops are triggering your thought process of what you did before, and you're really comfortable on those volatility drops, but they're not accounting for the fact that the bounce is actually counter trend bounce. And so it's not necessarily going to catch the swing and catch the air you're expecting, and then it slam dunks on you. And we're here talking about being assigned a whole bunch of shares.
Yep. Yeah. So I think you're right. And I think some of what you're saying is I don't necessarily say that you have to be a bull market to do what I'm doing, but I think your option play has to match a macro trend. And what I mean by that is I actually started trading in almost 3 years ago today, ironically, back in 2019. So it was around October, November time around there, made my first trade. I was trading through the Corona crash of 2020. I did well in the Corona crash in 2020. I actually was green during that whole crash. And my trades at that time were bearish option trades. Again, I was with that more macro trend. Most of my other trades within 2020 were more bullish trades. Also won a lot of those. In 2021, I had a couple of bearish trades that I traded that went really bad for me, and I got scared. And so the majority of every option play I put on had a bullish tilt to it in 22. And I think that's part of it. Is it's not necessarily you can only trade options in a bullish thing. I'm considering trying to match the option strategy with the macro trend. Yeah, so let's take these shares that I recently got in Amazon. And for those of you that you just go back a few episodes here, I actually sold an Amazon put, and then I rolled an Amazon put, and then things got really ugly. And actually last night, I got assigned Amazon shares. So I was short the 115 put. We did some episodes on after the earnings announcement, how terrible that can really make you feel. I was fine to be long those shares from that 115 strike. That I'm not having any sort of remorse into actually owning them. I still believe in those. I just think it's going to take me a little bit longer to come out of. So let's just take a look here at the chart to kind of fresh this up as to what I did. So this is a chart on Amazon, and these candles are weekly candles. I actually put my first trade on Amazon on August 29th, which was around this candle here. And I sold the 115 put. So we were trading around $130. That was $15 down. That was kind of, down here in this kind of cluster area. My gut at the time was like, oh, look, we've been going up. We did this kind of retrace right here. We kind of climbed. We kind of retraced down here to 130. And I was like, okay, great. Let's get the increased volatility here. Let's sell it. And then it's going to come off this thing and we're going to make higher highs, whatever. And I sold it on the 29th. The next week was good. And I'm like, oh, this is awesome. This is working out just like I planned. I think I even got to like 60% profit or 50%. Like I was right at my limit. And I think it was one of those ones where I said, oh, well, I'll close this out on the show tomorrow or something like that. And then wham, I started going down again, and I kind of lost and didn't lose everything, but basically I lost all those profit gains. And you can really just see where Amazon went from there. And then there was earnings announcement that came out, and then wham again. And so, I was 130 up here thinking, great, we're going somewhere. And here I am now holding 100 shares of Amazon at like $85 or something today. And so this is, I want to start with this as an example, Viper, because the way that I really approach some of these things is I'll pick a trade that didn't go my way. I'll pick a trade which could have worked out better. And I'll try to say, what could I do around this trade to make it better in the future? I'll write down my theory. I'll write down my hypothesis. Then I'll go test it on other trades and see, does it work out? I'll pick loser trades. I'll pick winner trades. I'll be like, does this new rule hold water? So I don't go fire off capital against it, but I start forming a hypothesis. And the high level hypothesis here, before we start jumping in and charting any levels, is looking at what's here on the chart. And you're like, hey, you dingus, because I know somebody out there is watching this and they're like, dude, why were you bullish on Amazon here at 130? It's very clearly in a downtrend. Can't you see this higher high, this lower high, this lower high? You're going lower, bro. Why are you playing bull on this? And that's the hypothesis here is maybe what I did was I tried to buck the macro trend. And what I should have been doing is understanding what this macro trend is and then playing an option strategy that matches that macro trend.
Yeah, and I would just add, to that question is the point that we are trying to make is the potential reason why you were still bullish on that was because you didn't have this foundational exercise mechanic of proper TA, technical analysis, and price action on the chart, which is really why we're really driving and focusing on this, not because we're by any means experts in this, but because it is our current primary focus to hone and learn and grow in. Because just in the growing that I've done in, we'll say literally within the last week, even since the last episode where I talked about some price action stuff, like just in the growing I've done in the past week, like I look at this chart, and first of all, you got to be very careful when you're looking at charts like this exact one that's on the screen there, because hindsight is always gonna rear its head and be like, well, duh. But when I try to cut the chart right where Sprocket said he entered, and I ignore new action, I still see now with my fresh eyes of learning and growing, I still see why that was really a bad entry to be long on. But at the time, it was doing everything that we collectively, certainly Sprocket, wanted it to do. We got this big pump. We're coming down. Cool. Everything retraces. So we're just doing a little retrace. Let me grab the retrace, buy the dip. Let's go. But there's a lot of technical things that I think in this episode we want to really try to highlight and suss out, because I see all sorts of red flags now looking at this. And so that is what we want to try to unpack here in this session. So now with that in mind, let's dive in, and let's kind of now, at least initially, how about we set the stage with no more hypotheticals and what ifs and rewind the chart. Like, go ahead, zoom out, bring us to modern times. And, so now you're sitting here with these shares. Price is where it is right there. So walk me through what you're trying to accomplish now that you're holding the shares, and what your thought process is in navigating your current situation.
Yeah. So I guess my strategy whenever I hold shares like this is to flip over and sell a call. So selling a call is a bearish trade. You basically want to sell the call as close as you can to the strike price. You want the price to be as close as the strike price as you feel comfortable with when you sell the call, knowing that you're going to drop away from that call. And if I was to turn around and sell a call right now here at $86, I probably couldn't get that far. I'd probably be looking at $96 or $95 would be as far away from our current strike as I could get and still collect a relatively decent premium. So what I want to try to navigate here is try to predict if this starts swinging up, which eventually it will start swinging up. How far up do I believe this swing could come? When it reaches that level of which I think it should start to swing up, somewhere around there is when I want to sell the call. And the theory is if it swings down, great, I'm going to keep that money on the call. I need to be okay selling shares at that price. So we got to kind of do this before it gets too far away from my current strike at 115, or it's never going to get back there in the near term. So I guess that's my current strategy on what I'm doing with these shares. Yeah, Viper. So I'm sitting down here at 85 now with 100 of these shares, and I want to basically sell a covered call because that's a play I can make. Actually takes no capital whatsoever to sell a call because it's completely secured by the shares that you have. The drawback with a covered call is you will be obligated to sell your shares at that price if you ever reach it. So the important thing for me is, I was assigned at 115, which is up here. That's not really my cost basis, and that's not really my break even, because I sold the original put for premium. I actually rolled it for additional premium just before earnings because volatility got even more juiced. And my cost basis is actually at 106.50 if you take into account all the premium I collected from that 115 strike on the 2 times that I sold premium against it. So my rule whenever I get into these type of underwater or assignment positions is I will sell covered calls, but I will not sell them below my break even point, because remember what that means is that means I will sell those shares for that price. So if I were to sell a strike at say $100, I'm guaranteeing that if I took assignment, I'm losing $650 because that's $6.50 below my cost basis. So as we go back up, I will not sell a call with a strike lower than 106.50, and I would like to sell a call as close to the money as I can when that stock is about ready to potentially go back down and retrace. So I want to try, Viper, to use some sort of price action rules to mechanically know when that number or when that value actually arrives.
Okay, so that makes sense, and I think that's a worthwhile endeavor here to try to figure out where we're at now and when will we get to that level where a covered call makes the most sense and is backed by that price action to make that particular move. So let's jump straight in over here on my screen and try to do my best on walking through this. Might get messy, but we're going to try. And at any point, mid-sentence, whatever, make a noise if I need to clarify something. But let's see what we got. Okay, so the first thing I want to put on the chart here is just where you said your break even was, your cost basis. So you said what, 106 and change?
106.50. 106.50.
All right, 106.50. Let's keep it super accurate. Just kidding. 106.58. That's as close as we're gonna get.
Okay. Done.
So I'm gonna drop that over there and intentionally off to the side just for a second. But let's make it nice and fat so we know exactly where it's at. So obviously we're in this range here. We're at 86 now. We want to be up at 106. So for the time being, we're just going to ignore this big muffin top up here and just focus on a general range, that's in the area that we're concerned with, because big moves take time. And so we want to get some levels going, at least from a historical perspective. But there is some nuance to that, which I'll try to clarify as we go. All right. So the number one thing with putting levels on the chart is, obviously we could sit here and we could go, okay, this was an all-time high. And literally many times on previous episodes, that's exactly what I would have done. And it's still, it's still a fine thing to do. And if you find success in it, if you find something that works for you, it's not a bad level to mark. But what I want to try to do first, though, is go through this and this idea of charting the failures, because in every chart and every price move, it will have moments of failure, and in that, failure just means, whether it's up or down, a swing, an entire swing section failed to do what that swing should have done. And the reason we want to mark those failure levels is because when a failure level presents itself, there should be an expectation that when that level becomes important, it should get tested. And then we should test it and we should confirm or reject it. And then that kind of clears it off the box. So at a high level, let's picture we drop a level as soon as we see it appear. And now going forward in time, it's untested because price is still discovering, it's still going up or down, but it was a failure. And so we should expect that at some point when it becomes important, we want to see that level checked off the test list. So every time a failure happens, we create a list of this needs to get tested at some point. So with that in mind, let's take a look here around this 86. And again, I'm starting on the weekly because that's really where you're going to get the cleanest data, but you're also going to get very widespread data because these are large candles. They're long time frame, but it is helpful to start out here. So
we'll see where you go with this. I'm having trouble visioning the mechanics on how to make this more mechanical, but we'll see what shakes out.
And then as you can see, the flip side is what actually happened, where we actually bounced up, we gained, and now here at this point in time, hold your horses. We're still not making any trades. We're still waiting. This is not confirmation at all. You can gain and still lose the level. But what we want is we want to see a gain. And if we're long biased or looking for a long entry, we want to see that gain come back and grab support and get a bounce off of it. And so our long entry, after all of this, our long entry is actually somewhere in this area here. And this kind of calls back to something that I talked about before on the previous episode, where you're picturing you're climbing that ladder. You're reaching your hand up. Just because you reached your hand above the rung doesn't mean we're safe yet. You could still slip and lose it. What we want to see is the good grab where you come down and you get support off of this and then you keep going. So that's my first failure level that I want to chart. And we'll actually play forward now and see, have we tested it yet? No, we have not tested it.
Hold on. You said we have not tested it.
Yeah.
What do you mean? We did test it. Tested it right there. That's where you said you wanted to take along.
Yeah, and you know what? That's a very good point, and it is a it is a struggle of mine where I do two things. I go back in time, like we just went historically back here on all previous episodes of price action. I've gone back in time, and I've marked these levels, just like we just did. So everything I just did about this analysis at here, 100%. That is, to your point, that is identifying this move. If we were talking about this point in time, this is an important level based on that analysis. But where I start to confuse myself and get myself into jams is, I mean, let's look at how much time here. I mean, this was, several years ago.
Yeah, that's like when I started my trading career.
Yeah. So there's, so where I get into trouble is I spend too much time trying to identify these levels, and then I zoom into recent action, and I just, I see this pretty level here, and I'm like, okay, so we're just going to come down here and we're going to bounce off this and yada, yada, yada. But that's combining two very different things. That's combining just the knowledge of a level and price action. So, good call out. And let's bring it into recent times. Here at 143, this failed to do anything per the previous failure, and the previous failure failed to make a new high per this high. So I do just want to back up one step here and say this failure here started somewhere in this range at 152, and again, we're going to get a little bit more specific because we're on the weekly, so that's, some of these levels are slightly off base, and that's because the weekly just isn't going to always magically line up where you need it to, but it is a good granularity for spotting some of these moves.
Yeah, for me, I just don't understand why you draw the levels. Like, for example, your 153 there. Why you would choose to draw that? Because if you take that previous local high, the one that happened on the 28th of March, and I say, hey, where did that swing start? I would either mark it that almost cross candle on the 7th of March or the bottom of the candle that you chose to mark the top of. And if you mark where I mention it, you will see that the second higher low or lower high fails to gain that, but actually tries. It touches it. So I almost feel, and if you go back to the set of high before that lower high that we just talked about, it seems that the price action always comes back to where the swing that brought you that most recent local high started from, and then it tests that and either continues lower in the case of, we've now made a new lower high, or it would pass it, which hasn't happened yet. Which is why I kind of think in my theory that we will come back up to what I would say is probably a 107, because that is where the most recent local high, I think, started from on the 5th of July.
5th of July.
Which is one candle back from where you marked.
I see. So,
because what I'm trying,
so at least, so there's a couple things I think I want to unpack, because one of these things, the second thing I'm going to get into, is a little more prudent to an honest to goodness struggle that I'm having right now on my own charting. But the first thing why I would pick, like, let's take this 152 because it stands out pretty clearly, and we have your white line where you would draw it and where I drew it. The reason I drew it there was this idea of where a move starts. To me, the move, and this could just be an ideological thing. Maybe it's not actually a technical thing. But to me, if we have a downtrend that dips and then goes up and does whatever it needs to do to clear a previous high, to me, so obviously to you, it's wherever you bottomed, you started going up. To me, where I've been trying to consistently draw my charts is just one tick before that. So we'll switch over here to some red. I start here because the move is this sweeping move where we sweep down and we start picking up support as we're sweeping, and we start gaining, and then we clear where we started, and then we're off and running. So I'm literally thinking out loud because I don't know if that's satisfactory in any way other than to say there is the potential that this same starting point sweeps down and finds a weak floor, and then we just keep going down. And so
maybe a better way to say it is not where the move started from, but what was the low that occurred prior to that most recent local high. The reason I say that is because I think that is what you have lost. So your local high in the chart, you didn't lose the local high. That's still your local high. Where I say is something is significant is on that downtrend from that local high, what you have lost is the previous low, which in my mind starts at the bottom of that U because that's the low. But I think you could change it to basically be that one outlier candle which holds the local low prior to that local high. So maybe a candle back. And what you go back to retest is you're retesting that level at which you lost. And what you lost was that level there of that local low, which is July 13th or June 13th. Because I want to try to keep it very simple. And I think if you scroll to the right so you see more of the action, that June 13th low, local low, that is what you lose when you're falling off of that high.
Okay, so let's do this. Let's put that to the test because where. All right, so we're gonna do. You want the body or the wick?
The body, the bottom of the body.
Okay. So you say that is what you say that is what we
lost. You can
lost.
do it backwards from the previous local high, not this one because this one's on. Yeah, I'm saying that is the level that we when we lose that level, we are now continuing lower. We're going to find a new lower low. And when we find that lower low, we're going to go back high. We're going to go back up. And I believe we're going to travel up to at least that low. And we're going to test it.
So some of that. So at least in the candles we're looking at, I don't feel like your 103 level here is as obvious on the we lost it. It's only obvious in hindsight because we have like, or let me say that another way. It's midstream when we cross this 103. We're already gone at that point, and so that's what makes me think that's not where the level actually was. I'll stop there. Does that make sense?
Yeah. So honestly, that white one I just threw out there because you were having a hard time where you marked the swing. So I said, well, maybe just mark it at the lowest point. I still believe that you trace back from that local high to where that swing started, which I think is actually, just a little bit higher.
July 5th.
Yeah. Yeah. But I don't know that makes much of a difference. And I still don't think it's midstream because your candle closed below it. So we're going down. So what I mean by that is go back to the previous local high that we had before this one, right? It's because you can see the whole move played out. And if you go with where you mark the level, we never tested it, which is your yellow 152. The reason I think that's not a good place to mark it is because we didn't test it.
Well, we didn't.
And
we didn't.
I think you have.
We might have. We might have right here. That's part of the granularity. We could have. And actually, let me get this 143 out just for a second. We could have. So now let's jump to the daily.
But I don't want to jump to the daily, right? Because then you're going to start identifying all kinds of micro levels and you're going to get lost in the weeds.
Well, no, but a test is a test. So, I mean, just like I got lost saying this was tested back here, and then I basically nullified that by saying, oh, we've never tested that. So that's where this is where the granularity can mess you up on the time frames. And I don't want to go too low, but my only point was if I mark it here, which this was my number 2 issue that I'm struggling with right now, is on the weekly, like going closer to the wick almost makes more sense to me because of how much time is encapsulated in those wicks. I mean, I try to do bodies only, and I'll keep doing bodies only here, but that's just something I'm struggling with currently is these are big candles. And so these wicks aren't just like snaps in time. Those could be multiple days. But anyways, even though this looks like it was never tested, I think it's perfectly fine to go. I mean, I think it's fine to go even deeper, but we'll just go to the 4 hour and see.
I don't think it was ever tested. You're talking about your 150 level.
Yeah. And I would agree. It wasn't. So all I was saying is on the weekly here, just because we didn't see, and it turns out it tested, but I've certainly seen it plenty of times where this level, I do stand by marking this level, even though on the weekly it looks like we just blew through it and we didn't test it.
So I guess what I'm considering a test is a reversal of the price. So to me, your test is coming back, testing it from the other direction.
Yeah.
Which is why I said it wasn't tested, because you're red, right? You fall through that level. And so to me, the retest only can happen when you're reapproaching it from the bottom because you crashed through it.
Yeah. I agree.
So that level's not significant until you fall through the bottom of it. And you can see once you fall through the bottom of it, you never come back up and touch it, which is why I'm saying not to mark that one and you mark the other candle. And maybe you split the difference and you just mark the whole freaking band between yours and my mark because it's all just arbitrary anyway. I guess the key point I'm making is we seem to be swinging back up always to the thing we lost.
Yeah.
So in the most recent action, I would expect that at some point those candles are going to go green. And when they do, those green candles are going to work their way up to probably the band between where you have the yellow 114 and where I suggested putting maybe a 104 or something like that.
Yeah, so I'm fine with that idea because I do think ranges are important. Um, so on this particular chart, uh, you would have it somewhere around there.
Yeah. So I guess where I'm trying to go at this here is the way that I would approach this is where we are now. What is that same band that we just went through there on the off of the previous local high? So what is that same respective band from the most recent local high?
Yeah.
And then that is the range at which I need to start looking at selling a call when we make it back to that range.
So I would say it seems like, I mean, together we make a good range. Where,
So maybe here's maybe this will help a little bit. So to me, if we mark this stuff on the weekly, right? To me, that would say, hey, when you get, to this 105 level or whatever that weekly level is that we mark there in white, okay, the bottom, whether it's your marker or my marker, when you get to this range, when you get to this thing, flip over to your daily candle, and that's when you start hunting for your exit or your entry into a call, right? That's like, okay, we are now approaching your destination. Let's take a click down, and then you use the more micro trends to decide at which point you're going to jump in. That was my first thought off the cuff.
yeah. The other thing that I thought of off the cuff is, so first of all, 104, this bottom candle, is that where you want your level based on the weekly?
Well, I don't honestly know where to put that level. It's either where that swing, in my opinion, it's either where that swing started, okay, and that's debatable on what you call it, but the definition, where you mark it, I don't care. So to me, the level we've lost is either where that swing started or the previous local low that preceded that local high. One of those two things are what you mark. Maybe that's what you mark the range between. I think I am starting to like the way I said that because I think it gives you a little flexibility. You're looking at a range, and maybe that range is from the previous local low, from that point, bottom of the candle, to wherever you mark the swing start up. It doesn't because it's too far out for a 30 to 45 day trade. I guess what my point is with the timelines is I feel that you always draw levels off of candles, right? You're always doing that. No matter what time frame you're on, you're drawing the levels off of candles, right? So you can draw levels on a weekly candle, and those levels correspond to weekly candles. They just happen on a much wider time frame. Within those candles, there are other levels, and I feel like you're trying to click down to look for a finer grain detail level, when in actuality, you will get another level that's outside of the one that you mark that's less precise, that's made from the bodies of weekly candles. So if you look at the weekly chart, you can draw levels of, oh, this weekly it touched here and it's bouncing off of here. And I almost feel like you pull out the microscope or the magnifying glass too soon to basically see a level that matches something, like the test of it. Because you're like, oh, the test happened inside the middle of this candle body or something.
Yeah.
And maybe there was something in there, but I don't know that that's significant when your time frame of the trade is on the order of, multiple weeks. I feel if you stick to the bodies of those candles, the levels of those are what makes sense. That's my point, and that I think we lose that when you drill in and say, no, we touched it here, which is true, which is why the big red candles keep going. But
Yeah. And that, I think everything's fine there. The whole point of just we touched it, like you just said, I think that at least sums it up. That's why the red candles keep going. Nothing about the fact that we touched it was meant to imply we're never coming back here. I'm fine. I'm fine with everything you just said about this cluster, and we're going to be back here someday. The point of we touched it was, just to repeat it, that's why the red candles keep coming, and so that's why we're down. We're in big down mode now. I think I would add to your thing about clusters that this is also yet again another power of options, because somebody who had just bought, so for all intents and purposes, now that you've been assigned, you've just bought shares at 106.58. So someone who doesn't know about options is going to think, I have to get above 106.50 in order to get out of this thing and not take a loss. And so the power of options is, if we just transpose, your buy-in to this previous motion here, because this is kind of like what we might see with current action. We can be down only this cluster here, pretend it's this cluster, we just shifted everything up, and say in time we're actually on this candle here. So pretend that's where you bought in. Somebody might think, without knowing options, that I have to get above this blue line before I can get out. But in reality, all you're looking for is to get close, which obviously happens right here. So the power of options are, dang it, I didn't make it. You don't want to sell all those shares and take this loss. But this, would you agree, this is potentially, there's a lot of factors into selling a covered call. Potentially, this is a decent strike away to get.
No, definitely. Definitely.
And so,
and that's what I'm saying. Like, once you get close to it, which is why I just need a range, then you make sure your strike is set above there, collect some premium, and keep doing that.
Yeah. So I think that's certainly the power of the situation you're in.
Yeah, so Viper, this is a good discussion here. I really have no idea how this will end up sliced and diced in there, but let's kind of close it out here by switching back to my chart here, because I think fundamentally we did come to an understanding, at least some relevant levels, and that is, here we're looking at Amazon up to date. What we really called out is we both agreed that this 104 level down here was a legitimate level of something that we have lost, that we will touch again or test again. Now, we got into some debates on where exactly that's retested, when that's going to be retested. Fundamentally, if we go back to my original requirements, it was, I cannot sell a strike below 106.50 or I guarantee myself a loss. And so what the options trading is about is, it's about selling a strike above there. So you're okay selling shares at that price and you collect a premium when you do it. And my goal is to say, where is this chart going from where we are down here at $86 of when I can start considering making that play? And if I just look at this thing real rude and crude, you can see up here we have, a local high and we fall, and we have this cluster here and we raise up, and then we have a lower local high, and then we fall, and we have this cluster here and we raise up, and we have another local high. And if you notice, this local high here is not that far away from this cluster that preceded the previous local high. And same thing before, this previous local high, before we got to this local high, there was a cluster. And where did this local high stretch up to? Where did this lower local high stretch up to? Real close to this cluster. And so I think the only takeaway that we've come to, and this is far from a mechanical approach, so we've got more work to do, better brew some coffee and do a different night, is presumably this low, we're going to crash down here, and at some point we're going to come back up and we're going to approach this cluster. And it doesn't have to, we don't necessarily have to get above this 104. If we do, wonderful. We don't have to get above 106.50. The only thing we have to do is sell our strike above 106.50. And the reason I say that is because once you get close to this area, going out 30 and 45 days, we'll still collect good premium for a 110, maybe even a 112. And that's fine, because if I sell at those prices, I don't lose money because my cost basis is 106.50. I collect additional more premium. And so really, I think the play that I'm looking for, the price action I'm looking for, is for this to come back up somewhere around 104. Presumably we'll make more candles like this on the weekly level. You know, we can debate that in future episodes, and we'll keep digging into this. But that's really the play on Amazon, for it to come up there. When we get there, sell that call. If we go back down, great. Let's look for another run up. I'll have lowered my cost basis again because I'll collect more premium, and we'll just keep doing this until I can get above my cost basis, sell a covered call, exit from assignment, move on to some more plays. Meantime, we'll keep refining this because I really feel there's a mechanical thing here. There's a rule set we can apply. I don't know what it is yet. I'm going to keep exploring, and I'm going to keep checking it out, because once I find it, I really think it's going to help kind of change my approach to some of these trades.
So I agree that there is a mechanical approach that can be applied here. I would say probably one of the reasons we struggled the most finding it tonight is because we're dealing with we're trying to salvage a play that was not based on that mechanical approach. So I would say step one of the approach, I mean, it's not as crass as it sounds, but step one is make a better entry. And I feel like it becomes a little more clear when you do this based on a better entry. And so what I mean by that is we can just picture in our heads that 104 level. Price did come down close to that 104 level. So we could have identified that 104 level days before, even days before you actually entered the trade. And so we would have had that called out as a potential to get back down to. And so I feel like, and tell me if you agree or not, that had we waited till we got back, once we got rejected off of 145 up there, once we got rejected off there, if we waited and said, okay, part of the mechanical structure is we failed that 145, hold on, we're now set to go hit that 104 again. Let's wait, not enter where you did. And then when we get to 104, then go hit up the options chain, go find out, go make the play. Basically, if you had sold a put from sitting at a 104 strike, you're probably looking at, 90, maybe 95 put with maybe, let's just say, a couple dollars premium. So now you're looking at $90 to $93 cost basis. And I feel like now all of a sudden we're really starting to move into a much more productive direction.
No, I think absolutely focusing on the entry is definitely part of where I want to get to. I think the theory going into this episode was we could derive it from where we were. I'm not sure that what you just laid out, I would sell a put as we approach 104, because remember, the whole thing that got me into this mess was playing counter to the macro trend. And right now we're in a macro downtrend. So putting on a bull play any point in a macro downtrend, that's the part I'm questioning. However, absolutely, that would have been a good opportunity to sell a call as soon as we reject it off of 145, saying we're going lower. Let's sell a call spread, a spread, not a naked call, a call spread. And that would have been a good place for that. And then as we come down to that 104, that would be a great time to probably close it out for a great winner.
Yeah. All right. Well, then I'm I'm optimistic around 2 when we take a chart and start going. I want to enter, and try to derive that entrance criteria. I think it's out there, like you said. Gotta get
Yep. Well, we'll see how it goes. Expect to follow up. I'll see how this thing edits up. This could be really interesting. We've never done a show like this, so let us know if this was good, bad, however the editing comes out. I don't know what you'll see, what you won't see. So leave a comment. Let us know. More exciting news coming out. Like I said, crypto apocalypse is going on, so stay tuned to all of that fun stuff. We might dive into that in a future episode. Additionally, there's more inflation data coming out. Probably be out by the time this episode's out. CPI data comes out tomorrow. So we're really primed for a big market dump. So let's hope that doesn't happen. But anyway, good luck out there. There's not a lot going the bull's way lately. Hopefully you find pockets of goodness. Have fun trading, and remember, think outside the block.